One of the world's top billionaire investors just make a shocking call. Bill Ackman says some of the highest quality company in the world are trading at extremely cheap prices right now. And when I looked at his portfolio, 4 stocks stood out immediately. In this video, I will show you exactly what Bill Ackman is buying and why he thinks this might be one of the best opportunity in years. The second largest position in Bill Ackman's portfolio is Uber, taking 15.9% of the portfolio. We'll be using InvestKit to analyze the financials of Uber and understand what Bill Ackman sees, what Wall Street media does not see. Uber is making more than $14 billion on the top line, but for the bottom line, only $336 million left. So we can say that Uber is still a relatively low margin business. Currently, Uber trading at PE of 15 and for a PE of 16.5. Uber is one of the best examples of operating leverage. You can see the revenue was growing all the way up, but the net income was all over the place. From 2017 to 2022, net income was almost always negative. And then in 24 and 25, Uber printed more than $10 billion on the bottom line, which is really nice to see. On the margins perspective, we can see that most of the margins was negative, but from 2023, all margins went to positive side, and currently Uber is a relatively profitable company. Analyzing free cash flow and stock-based compensation, free cash flow, as I just mentioned, using operating leverage flipped in 2023, and stock-based compensation did not grow too much. We can see a stable stock-based compensation from 2022 to 2025, which is really nice to see. Free cash flow is growing significantly and stock-based compensation is static for the last 4 years. Really nice to see. From the perspective of shareholder return, Uber is profitable company, more than $9 billion in free cash flow in the latest financial year. Uber is not paying dividends, but returning cash to shareholders with almost $7 billion in stock buybacks in the latest financial year. Shares outstanding grew significantly from 2017 to 2021. Shares outstanding almost doubled from 1 billion shares to 2 billion shares. And then from 2021 to 2025, we can see that the shares is not growing anymore. And then in the latest quarter, Uber started to buy back shares, so the amount of shares decreased, which is also making shareholders owning more larger part of the company. Now, Bill Ackman told us that highest quality company are now trading at a discount. So let's see from the valuation perspective. Let's just change this interval so that we do not have a spike. And currently we see from 2023, the median price to earnings is 30. Meanwhile, Uber currently is trading at 15. Okay, what about the price to sales? For the price to sales for Uber, also the medium is almost 4, and currently we are trading lower than 3. So this is the cheapest Uber was in the latest 3 years. What about price to operating cash flow? Price to operating cash flow also significantly lower than historical averages, and for the price to free cash flow is also lowest than averages. So I think I see what Ackman sees. He bought Uber because he believes in a bull case, and now the company is trading significantly cheaper than historical averages. So he believes this is one of the best opportunities in the market. Now going through bull and bear case for Uber. Starting from bull case, Uber is finally profitable. I just showed you how they flipped from being unprofitable company to profitable and currently printing more than $10 billion in the latest 2 financial years. Really nice to see. Second, massive global network effect. The more drivers joining the platform, the less waiting times. So the more passengers are joining the platform, and then more drivers is joining the platform because there are more passengers. So this is network effects working really well for Uber. Third, Uber Eats is a giant business. So they are doing not only mobility, but they are also doing the food delivery, grocery delivery, and this is becoming bigger and bigger business for Uber. Fourth, autonomous vehicles could become massive. Now, before you start writing the comments that, Andrew, you have no clue and autonomous vehicles are absolutely bearish case for Uber, let me tell you that I have a bearish case as well for the bear case. But right now we are talking about the bull case. So how I believe autonomous vehicles could be a bull case for Uber is because currently they are making a partnerships with Waymo and other autonomous vehicles companies to help them for the distribution. So if this is the case, Uber could be a massive platform for autonomous vehicles. Fifth, huge addressable market. So currently they are doing mobility and also delivery, and these both are huge markets and they continue to grow. Now, the bear case. First, thin margins. As I showed you, in a revenue, they printed $14 billion. Meanwhile, to the bottom line, only $360 million. So this is quite thin margins for the company. Second, regulatory risks. Government is always complaining that employees of Uber should be permanent employee instead of contractors. Third, competition is still strong. In North American, European, and developed markets, we can see a lot of competitors are doing similar businesses with the mobility and also delivery. So the competition is heating up. Fourth, autonomous vehicles could hurt Uber. This is the bear case for autonomous vehicles. If Waymo, Tesla, and other companies will decide to remove the proxy, Uber as a proxy from the chain, they will be probably do that. But I believe from the beginning they will be using Uber to help distribution because Uber already have huge amount of daily and monthly active users. Everybody knows Uber. So they will be using Uber from the beginning for distribution, and then later they will remove this proxy layer to improve their own margins. Let me know in the comments below, did I miss any bear case for Uber? And also let me know, do you think Uber is a buy? Meanwhile, we will continue with the next company, which Bill Ackman believes is a huge opportunity, one of the best opportunities in the market right now. And this is Amazon with 14.28% of the portfolio for Bill Ackman. Amazon has many segments: online stores, third-party services, AWS, subscriptions, advertising, physical stores, and others. High margin businesses here is advertising services, which is combined with online stores. Subscription services here you have Audible, Amazon Prime, and others, and also AWS, very high margin business. Third-party sellers are relatively high margin as well. Amazon is trading currently with price to earnings of 29.2 and forward price to earnings of 22, which means the significant earnings per share growth is expected in the next financial year. When you see this revenue growth chart, you know this is a great company. Revenue growing, net income almost always profitable except 1 year in last 10 years. Free cash flow all over the place because Amazon was always reinvesting profits back into the business. So he didn't ever print a lot of significant amount of free cash flow. Even this is more than $2 trillion company as for now. Margins are all positive, but free cash flow margin was recently damaged because they are reinvesting a lot into the capex, and free cash flow is a cash from operations minus capital expenditures. So the higher capital expenditures grow, the lower free cash flow will be. Even though Amazon is $2.27 trillion company, they are still diluting shareholders. In 2017, they had 9.86 billion shares. Fast forward to today, they have 10.83 billion shares. So you can see almost always is buyback is red, which means they are diluting shareholders to raise more cash to reinvest back into the business. PE of Amazon is all over the place. Amazon is not really optimized for profit, so PE is not the best metric to value Amazon. Let's see the price to sales. For the price to sales, we have medium of 3.3. Currently, Amazon is trading with some discount of 3.1. And counting on significant improvement in Amazon's operating margins, I believe that this is quite a big discount for Amazon for now. The best metric to value Amazon is price to operating cash flow because the company investing a lot in capital expenditures, price to operating cash flow is the best valuation metric. And here Amazon is dirt cheap with medium of 25.88, and currently Amazon is trading at 16. The price to free cash flow can be ignored for now because capex is too high. 300 price to free cash flow for Amazon right now. Bull and bear case for Amazon. First, starting from bull, AWS is a cash machine. AWS is the first cloud created in 2014 and already printing more than $100 billion in annual run rate. AWS is a very profitable business, and almost for 10 years, Amazon is using these profits from AWS to fund their other unprofitable businesses. So this is a really big advantage for Amazon. Second, AI infrastructure demand is exploding. So now with all the AI and all the vibe coding, AI infrastructure is very, very needed. So there are many startups is coming and host their infrastructure on AWS. Third, advertising business is growing fast. Amazon has this Amazon.com, and Amazon.com is a relatively low margin business. But because they implemented advertising and combined these two businesses together, so now seller can advertise their products, make their products in the first or the second place of the search page or homepage. Now advertising business is printing billions of dollars in cash for Amazon. Fourth, logistics network is a huge moat. So now with all the vibe coding and we say the software is dead, the software is not a moat anymore, but logistics network of Amazon is a real moat because they have one of the best optimization for the efficiency, performance in a warehouse, in delivery, finding the best and most efficient route for delivery drivers. This is significant, and I believe in the future, the logistics of Amazon will be used for other e-commerce players. as a logistics as a service. Fifth, operating margins are expanding. I just showed you in a chart all the margins for Amazon is expanding, and I believe with robotics and AI, this will be another tailwind. And until 2030, I'm expecting operating margin for Amazon to reach more than 23%. Bear case. First, retail business has thin margins, but with advertising, this thin margins is not counting anymore. Second, heavy capex for AI and logistics. This is the bear case, which includes depreciation as well, but it is what it is. If you want to continue growing and continue dominating in the next 10 years, you have to invest, especially if you're Amazon. Third, increasing regulatory pressure. The big tech is always pressured by government from the perspective of regulation and rules. Third, competition in cloud is intensifying. So now we have AWS, top 1 market share. Azure is fast catching up, and Google Cloud is the fastest growing cloud, but they are growing from smaller base. So currently these 3 largest American cloud providers are competing with each other. Even with this competition, the margins for all 3 businesses are very profitable, and operating margins are reaching 30% for all of them. Fifth, slowing e-commerce growth. Especially in the developed countries, the e-commerce is already relatively developed and the growth is slowing down. But there are a lot of opportunities in emerging markets, and Amazon is trying to go there. For example, South America, or for example, Southeast Asia. Amazon is also trying to go and compete with the local players in that market to take some market share. For Amazon peak, personally, I totally agree with Bill Ackman with forward PE of 22.2 and PEG of 1.9. Amazon is just too cheap to ignore. That's why this is my largest position in the portfolio, north of 30%. I'm very confident in the future of this company. Meanwhile, the next company in the list is Google, and we have 2 Googles. First is GOOG and second is GOOGL. So actually Ackman has both tickers, mostly GOOG. This is the same company. For analyzing financials, we are using InvestKit. I will leave link in the description below. If you want to analyze the companies very fast, growth, margins, profitability, valuations, yields, insider transactions, you name it, you just click the link in the description below and try it out. Currently, we are doing beta test and all the premium features are available for free. Google is advertising juggernaut. Most of the revenue is coming from search. $63 billion. Google Cloud is growing very rapidly. In the latest quarter, they grew 48%, $17 billion. Subscription, platform, devices, $13 billion. YouTube ads, $11 billion. Network revenue is shrinking, currently taking less than $8 billion. Google is a very profitable company. $34 billion is coming to the bottom line for Google per quarter. Price to earnings of 27 and forward price to earnings of 22.3. PEG ratio 2.3x. Google is a very profitable company. Revenue up to the right. Net income profitable, more than $100 billion in net income in a one financial year. Mind-blowing numbers. Free cash flow is huge, which allows Google to reinvest significantly back into the business and gives advantage to, for example, to compete with OpenAI, because OpenAI does not have such huge amount of free cash flow, so they need to raise money from investors on a private market to continue growing. Meanwhile, Google's search business is a cash cow, printing cash to allow them to grow Gemini and improve the AI businesses. Free cash flow is huge. Stock-based compensation is not growing as much as free cash flow, which is really nice to see. Google is very shareholder-friendly company. They are printing more than $73 billion in free cash flow and returning cash to shareholders via stock buybacks of $45 billion and dividends of $10 billion per year. Until the latest year, Google balance sheet was one of the best balance sheets in the world. In December 2025, they took some debt, and now total debt is $72 billion, but total cash and cash equivalents are still $126 mind-blowing billion. Shares outstanding for Google was dropping significantly. In December 17, they had 1407 billion shares outstanding, and fast forward to today, they have just $12.23 billion. You can see buyback yield in average is around 2%. For the last 10 years, currently from the perspective of price to earnings, Google is trading at their medium, 27.36. Let's have a look at price to sales. For the price to sales, Google currently is a little bit expensive with medium of 6.3, and currently Google is trading almost at 9. So here we can see it's relatively on the top side of the valuation from the perspective of price to sales. The best metric to value the company which is reinvesting profits into capex is price to operating cash flow. Currently, Google is also trading more expensive based on the historical averages. Medium is 18 and currently we are trading at 22. Price to free cash flow can ignore because Google is investing too much money into capex. So free cash flow is not price to free cash flow is not relevant valuation metric for this current stage of the company investment cycle. Bull and bear case for Google. Let's start from the bull case first. Dominant global search engine. Currently, Google search is taking 90% of search market share. Second, extremely profitable advertising machine. Google's advertising return on investment is very, very large. Meta's and Google are two leaders in advertising. So advertisers have no more other place where can they put their ads money to get the high return on investment except of Meta and Google. 3. AI leadership with Gemini. There was there was a lot of statistics that Gemini is taking market share from ChatGPT, and for the last 2 years, it took significant amount of market share. Fourth, YouTube monetization growth. YouTube is a growth machine. I cannot imagine my life without YouTube, and YouTube is the main competitor of Netflix. YouTube has more watch time than even Netflix. 5. Strong cloud growth. In the latest quarter, Google Cloud grew 48%. Meanwhile, AWS and Microsoft Azure grew significantly slower. Now, I have to say that AWS and Microsoft Azure are growing from the bigger base. So when you are growing from the smaller base, it's easier for you to show the high growth rates. But anyhow, the acceleration is showing that Google is doing everything right. Bear case for Google. First, AI could disrupt search economics. That is exactly the bear case we was worried when Google was trading at $150 per share. And after Wall Street stopped worried about this bear case, Google ran up to almost $350 per share. Second, antitrust and regulatory pressure. Big tech is always pressured from the perspective of regulation and government. Third, rising costs for AI infrastructure. All these NVIDIA's GPUs are not cheap, and Google has to invest almost $200 billion per year to build their AI infrastructure. But they see significant opportunity, and the management during the earnings call, explained very clearly that they see a very large opportunity and they will invest all the money to take the advantage of this opportunity. Fourth, competition from OpenAI and Microsoft and also Anthropic. I would say here the competition is heating up, but I believe that Google has enough data, enough resources, so I believe that they will all have their part of the market share. Fifth, advertising revenue is cyclical. We know that after executives see that recession is coming, the first thing will be cut is advertising spend. So that's why Meta and Google are the first who will see the damage on their revenue because advertisers will just stop advertise because they will not see a lot of demand from the customers. The next and arguably one of the best opportunities in the market right now is Meta Platforms taking 11.37% of Bill Ackman's portfolio. Most of the revenue is coming from family of apps, $58 billion. Reality Labs is printing $1 billion, but significant losses is coming from this business segment. Meta is a very profitable company, $22 billion in net income coming to bottom line. Price to earnings of 24 and forward price to earnings, attention, 16.9. It's ridiculously low multiple for Meta Platforms. Price to earnings growth is 1. Based on a Peter Lynch, if the higher quality company is trading at a PEG ratio of 1 or less than 1, this is a significant opportunity, and Bill Ackman agree with Peter Lynch. Bill Ackman thinks that Meta is one of the best opportunity in the market right now. Let's see the Meta's financials. Meta is a very profitable company. Revenue up to the right, income, free cash flow, all growing. Zuck is paying quite significant amount of stock-based compensation. Stock-based compensation is $20 billion per year, but Meta is printing in average in the latest 3 years around 50 billion. Shareholder-friendly company. The stock buybacks in 2022 when we had significant declines, we had $44 billion spent on the stock buybacks. Really, really nice to see. Currently, Meta started to pay dividends and $5 billion per year is spent for dividends to shareholders. Meta's balance sheet was as clean as Google's balance sheet recently, but currently we can see that debt is growing quite rapidly and currently more than $80 billion in total debt. Meanwhile, the cash and cash equivalents are still reaching $80 billion. So now there is no worries for the balance sheet of Meta. And now let's see from valuation perspective why Bill Ackman believes that Meta is one of the best opportunities in the market right now. From the perspective of price to earnings, the Meta is trading at 24 right now, but forward is a 16. Price to sales for Meta is a 7.36. This is not as cheap as we saw in October 31, 2022, where Meta was traded as price to sales of 2, but still this is the close valuation to the COVID crash and also crash of 2018. So currently we are trading at the same levels of valuation with 2018 crash and COVID crash, which I believe is really a big opportunity. And price to operating cash flow is the best metric for value in Meta. And for this case, again, we are trading at the same valuation of 2018 crash and 2020 COVID crash. Really, really cheap. And price to free cash flow can be ignored because high capex for Meta platforms. Let me know in the comments below what do you think about these 4 companies and if you agree with Bill Ackman that these are the best opportunities in the market right now. Try InvestKit to analyze financials as simply as we did in this video. Everything is as clear as day if the company is a high quality company, if the company is cheap or expensive right now. You can run projections, you can do a reverse DCF to understand if the company is cheap or expensive. Give it a try to InvestKit and let me know in the comments what do you think. Thank you so much for watching and I will see you in the next one.